Thank you for joining the UWorld team on Statement of Cash Flows. My name is Quinn Perkson. Welcome to the UWorld. Next slide, please, sir. If you're here for Statement of Cash Flows on FAR, you are in the right place. UWorld is the sponsor. If you've heard of us, we are the leader in educational technology with over 4 million that have helped pass their certification exams. Absolutely incredible. We're in every law school, every medical school, and we're bringing you today the CPA maker to help you pass FAR. So we'll be talking about the CPA, and we'll be kicking it off here in a second with our guests. I want to first encourage you to ask questions during this webinar. We love your questions, and we will either address them as a group out in front, or Dr. Megan Burke, who is our subject matter expert, will be addressing them on the down low, on the backside. So your questions are welcome. We love them all. More importantly, we love making CPAs, and the UWorld program has a terrific record of doing that. Actually, it's a 90% pass rate, and compared to the national pass rate of 50%, this is stellar. 3 things you got to do to get that. First, you got, well, 4 really. You got to become a UWorld customer. We'll talk about that at the end. Second, you've got to study for 60 days. Third, you've got to take 100 practice quizzes, and then you've got to get 75% or more of those Smart Path targets and make them yours. So questions, we love them. The copy of the webinar will be sent to you on Friday. So just 2 days away, you'll get your copy there. But without further ado, I want to introduce you to the CPA maker himself, Peter Olinto, the global lead instructor for UWorld. Peter, take it away, and thank you so much for your time.
Thank you, Mr. Quinn. So, yes, I also want to thank my partner here, Megan. She's Megan the CPAs. Look at this, PhD. Yeah, you know me. So Megan is the best of the best. If you have any questions in the background, content related, she will be able to help you for sure. Quinn, any questions about the course, signing up, your firm, your school, you want to be an ambassador, Quinn's going to be your man, so he will be back on later. So thank you, Mr. Quinn. There you go. And what else we got? Yeah, today's agenda, Statement of Cash Flow. We're going to show you how this can be tested in both multiple choice as well as task-based simulation. So this is actually part of our text, so our ebook and how we go through. So we want to show you the quality of the content, the questions, etc. So you'll get a good feel for that today. Most commonly asked question, Pete, why do you do these for free? Well, it's free, kind of. It's free monetarily, but it's certainly not free in terms of your time. So we really do appreciate the 2 hours you're giving us to really earn your business. We are here to prove why we are the new sheriff in town, and we are the best of the best when it comes to CPA review, and why if you want to pass on the first attempt, UWorld is your world. So we got to do it all together. What we always do, just, you know, throughout our text, we always like to cite exactly what it is in the blueprint that we get from the AI CPA, so you know what it is you have to do. Okay, do you have to calculate something? Do you have to understand something, be able to analyze it? There's a command word, a skill level that we want you to know. So first thing is you got to be ready to prepare a statement of cash flow, but the commonly asked question is, Pete, both direct and indirect? No, indirect method. That now they could test in theory that statement of cash flow, whether you do direct or indirect method, you'll get the exact same result for cash flow from operations, whether you do it directly or indirectly, okay? But what you're responsible for, soup to nuts, is that indirect method. Now, sometimes they test it in a very obvious way, like give you all the information from a balance sheet, comparative balance sheet, an income statement, and ask you to do your statement of cash flow, or sometimes backdoor, like we're gonna have a task-based simulation I'll show you later, where they attempted to do the statement of cash flow, but there are lots of mistakes that now you have to identify the mistake and correct the mistake, okay? So we want you to be familiar with not only how they can test it explicitly, but implicitly as well. So we're gonna look at the impact of transactions that has on the statement of cash flow. You gotta be careful. Some transactions are non-cash, what we call non-cash investing and financing, which are a supplemental disclosure. Sometimes we buy PP&E, but we don't pay cash. Non-current assets go up, but we might issue a note. So then it's financing and investing, or maybe we issue stock to purchase that PP&E, non-cash investing and financing, supplemental disclosure, but not cash flow. Okay, what we're going to do in our TPS today is identify some errors. That's right, there's some errors. So another review course attempted to do a statement of cash flow, screwed it all up, of course, and UWorld is here to save the day. So we will detect, investigate, and correct any discrepancies. Okay, why that statement of cash flow is incorrect. And I'll also show you your check figure so that you know what ultimately that change in cash should be. So lots of exciting stuff. So preparing the statement of cash flow, as I mentioned, cash flow from operations, this cash flow from operating, investing, finance, you're going to see. But the cash flow from operations is the one where technically you have options, okay? What they're going to test mathematically, again, is the indirect method. But you're going to get the exact same amount, whether you do direct or indirect, the operating cash flow, that source or use of cash will be exactly the same, okay? Now, when you do the indirect method, there are important disclosures you got to give to the investing public, okay? Because you're going to see what we're really doing is going from accrual basis net income down to cash flow, but from the core business. So really, there's two things we have to adjust. We have to go from accrual basis to cash basis, and we have to go from bottom line net income, which includes operating as well as non-operating items and discontinued items. We don't want the non-operating, the gains and losses that are incidental. And we certainly don't want any discontinued things that are happening this year but will never happen again because you that segment of your business twice. So we want to go from the bottom line, which includes operating and discontinued. We just want to focus in on the operating items, okay? So we want to get from that net income to operating cash flow. But in that supplemental disclosure, we got to show the world cash paid for two things. What was the actual cash paid for interest? Not the amount you accrued for, but the amount of cash you actually paid for interest, because it's very important. Not all interest gets expensed. Usually interest gets expensed as incurred unless we're incurring that interest when we borrow money to construct a building, a factory, a warehouse, whatever it is, for use in our business. Then that interest during the term of construction gets capitalized. No. Analysts on Wall Street need to see what our interest coverage ratio is, the EBIT relative to the actual cash that has to be paid for those bonds, okay, or the notes, whatever it is. We want to see the cash paid. We want to make sure we can cover that as it becomes due. Whether you expense it or you capitalize it as your business, but if the company can't pay their interest as it becomes due, they're going to be rendered bankrupt. We also want to see the cash actually paid for taxes, because your tax expense on the income statement doesn't represent actual cash paid. There's two forms of tax expense. There's the currently due portion, the actual legal amount, when you look at your tax return and you come up with your taxes payable, but then there's the deferred portion, your deferred tax assets, deferred tax liabilities. So you'll see when we do deferred taxes that when you calculate tax expense on the income statement, it's really a function of your current year taxes payable plus your change to your deferred tax liability minus your change to your deferred tax asset. But that's for another class. The analysts want to see how much cash you actually paying for your taxes, okay? And then the impact of any transactions, if any, on the statement of cash flow, as we will see. Exciting stuff. So why do we need the statement of cash flow? A comparative balance sheet, if you look at your beginning cash and you look at your ending cash, you can sure as hell subtract and get your change in cash. The question is, why did cash go up or down? So the statement of cash flow explains why cash changed. Cash going up is not necessarily a good sign, because if you get fired from your job, how would you pay your bills if you had no earned income? Well, you'd have to sell your investments. Maybe you'd have to sell stocks, bonds, real estate. Cash is coming in, but that ain't a good sign if you're unemployed and you got to sell off finite investments to generate cash to pay your rent, because eventually you're going to run out of investments. Cash going down may not be a bad sign. As a matter of fact, cash going down might show the company's growing because they're buying more PP&E, they're opening more stores, whatever it is. They're investing a lot in R&D. All right, so we want to know why cash changed. What's the source, the inflows, and what is the use, the outflows, okay? So this is important to all users of the financials, whether you're an investor, a creditor, potential investor, a vendor, okay? Is this company going to be able to generate? Because if you can't generate cash from your core business, you're going out of business. So cash going up is, I'm impressed if it's something that's sustainable from the core business, from its operations, okay? So cash flow from operating, if you're a mature company, I sure as hell hope that's positive. The way we're going to analyze when we do our indirect method, we're going to back out things that are non-cash, like your expected credit loss, accrued expense, bad debt expense, warranty, anything that we accrue for, depreciation's non-cash. And then my gains and losses, I want to back out because that's not part of my core business. So we want to go to operating. Then I want to go from accrual basis to cash basis. To do that, we've got to look at our change in working capital. Really, our change in our operating assets and our change in our operating liabilities are a proxy for operating assets, because operating assets are technically, as you're going to see, all current assets except cash and cash equivalent. Current liabilities are mostly operating liabilities, but not all current liabilities are operating. A note that is currently due, a bond that is currently due, if that's negotiated interest-bearing debt, although it might be a current liability, it's not an operating liability. So I'm going to show you the difference between those. Cash flow from investing, change in your non-current assets. In the real world, I actually hope if I own the stock and I want to see the stock price go up, I actually hope this is negative. That means the business is growing. They're on the buy side of PP&E and long-term investments. They're growing. They're more. It's not a good sign if period after period you've got positive cash from investing. That means closing your stores, downsizing. All right, there's a direct relationship between growth and value. Lastly, financing activities. How are we going to raise our capital? What combination of debt and equity? So this takes a look at the change in interest-bearing, if it's short-term or long-term. If it's interest-bearing debt, that makes it a financing liability. And I want to take a look at a change in my own equity. Am I issuing stock, raising capital? Am I buying back my stock? Okay, treasury stock, that's an outflow. There's a signaling effect to that. Also want to know, is the company, I know they're paying dividends, okay? How do you know if a dividend declared was paid? If you don't see a dividend payable on the balance sheet, but you see a dividend was declared, yet there's no ending obligation, then I guess they paid it in cash, right? So we'll have to review that as well. Who's better than us? Let's go. So statement of cash flow. We want to explain. We want to know why cash changed, okay? So we're not only looking at cash, what else are we looking at? Cash equivalents. This is what I need you to remember. What is a cash equivalent? It's something that has an original maturity equity. It's got to mature. That means it's got to be debt. We invested in somebody else's security, but it has an original maturity of 3 months or less from the date of purchase. That makes it a cash equivalent. So we want to look at the change in cash as well as cash equivalents. The last thing is restricted cash. This is what is restricted cash? Held by the entity for what? A specific purpose. So it is not available to use freely. It's been restricted in some way. Okay, so there's a specific purpose, cannot use it. All right, so our statement of cash flow, you ready, is going to reconcile. First of all, you're going to have a check figure. When you take your ending cash, and this is on your balance sheet, your comparative balance sheet, last year's ending is this year's beginning. Take this year's ending minus last year's ending is this year's beginning. There lies your check figure. If I do my statement of cash flow correctly, I should get that change in cash. But I want to know why cash went up or down. So I want to calculate cash flow from operations plus or minus my cash flow from investing plus or minus my cash flow from financing. The number I get here has to match that comparative balance sheet. Then you add your beginning cash, and what do we have? Your ending cash. All right, and how are we going to have to calculate that cash flow from operations? In the real world, you could do it directly or indirectly. What are we responsible for on the exam? Indirect method. You're going to know it inside and out. It's going to be your best friend. So comparative balance sheet is where we're going to get this information, okay? So we will know our change in cash before we do it. We got to reconcile. We want to know why cash changed, okay? So statement of cash flow, balance sheet, they tie together. This change in cash matches that change in cash per the balance sheet. But the statement of cash flow also ties to what? The income statement, because our cash flow from operations is going to start with net income. We will now reconcile and explain why accrual basis net income on the income statement is different from the operating cash flow generated from the core business. What you never want to see in the real world is net income going up, but period after period, operating cash flow going down. Over a long enough period of time, think about it. What's really the big difference between accrual basis and cash basis? Timing, right? When you record this as revenue, not yet it's a liability for now, but eventually it should become revenue. Currently it's unearned, but it'll eventually be earned. It'll eventually be cash, right? You accrue for expenses. I haven't paid the bill yet, but due to the matching principle, I'll book the expense now, but I'll pay it in the future. At some point, you better pay it. So over a long enough period of time, if the growth rate in net income is persistently higher than the growth in operating cash flow, or you don't flow growing at all, then I don't believe that net income number. Low quality of earnings, okay? In the real world, analysts on Wall Street want to see how much of this net income number on the income statement is cash basis, objective, versus management bias, accrual basis, estimated, dependent upon methods of accounting and estimates, etc. Good stuff. All right, so cash flow from operations. Ready? Where does that come from? Our core business. This is what we do all day, every day. It's the reason we incorporated. McDonald's can generate cash from selling stoves and refrigerators. When those appliances get old, they sell them. All right, they just throw them out. They sell them. They generate cash, but that's not what the business is selling. McDonald's happens to be one of the largest private owners of real estate. But they're not in the business of selling real estate, but they could. They could close that store in Manhattan where they bought the land 100 years ago for $10 million, and now it's worth $1 billion, generate a huge gain. But a savvy analyst on Wall Street is going to say, wait a second. You can't repeat that gain because you can only sell that property once. And not only that, if you close the store, how the hell are you going to sell hamburgers and french fries in the future if you close the store down? So even though cash is coming in now, you're downsizing. And value is based upon what we think is going to happen in the future, not necessarily what happened today, right? So we're looking for sustainable, the core business. So we're going to look at our change in operating assets, which are all current assets except the cash and cash equivalents. So you know what that is. That's going to be your accounts receivable, your inventory, your prepaids. Okay, accounts receivable, inventory, prepaids, and there's one type of investment. In the United States, we call it a trading security. Sometimes it's called held for trading. For my friends out there, you call it fair value through P&L. If it's a current asset, then it's an operating asset, that trading security. Not to be confused with fair value through OCI, or what we call in the US available for sale. Okay, that's generally not going to be an operating asset. Held to maturity, also known as amortized cost, that's generally not operating. An equity method of investment where we have significant influence, that's not operating. That's a long-term investment. Okay, same thing when you own more than 50%, eventually you're going to consolidate. That's also long-term. Okay, none of those are operating assets. And your change in operating liabilities, all non-interest bearing obligations, non-interest bearing. Okay, and I'll talk more about that in a second. Investing activities looks at the change in what? Your non-current assets, your PP&E, all your investments other than the trading security, also known around the world as fair value through P&L, and also your intangibles. Okay, that's investing. Ironically, cash going out the door is a good sign. You're buying, you're growing. If period after period, you're liquidating your investments to generate cash, what the hell happened to your core business? How come your core business isn't generating cash? Why do you got to sell your stocks and bonds and real estate? Why do you got to close stores to generate cash? Not making me happy. Financing activities looks at what? Interest-bearing debt. Interest-bearing. How do you know for sure it's interest-bearing? You ready? Here are the buzzwords you all are going to look for. You see the word debt. You see the word note, you see the word bond, you see the word debenture, you see the word negotiated, or you see mortgage. What do they all have in common? That's all interest-bearing debt. I don't care if it's short-term, I don't care if it's long-term. If it's interest-bearing, it's financing. Okay, and then our own equity, not stock we own in other companies, folks, our own equity. All righty, whether it be preferred equity or common equity. That's all ways to finance your business. There's advantages and disadvantages of issuing preferred equity versus common equity. And anytime we actually pay, not just declare, but not a stock dividend, not a property dividend, it's got to be we pay a cash dividend, not stock, not property. Okay, that's going to be all financing activities. Okay, so last but not least, you ready? Whenever an asset goes up from here on in, short-term or long-term, I want you to think buy side. What's the relationship? Inverse. Cash is going down. When an asset goes down, I want you to think, hey, that's on the sell side. cash is going up. If there is no cash in or out, then we have a change maybe in a receivable or an inventory. We'll talk about that, okay? But assets going up, you think buy, cash down, and vice versa. Anytime liabilities or equity go up, you're issuing the debt, you're the borrower, or you're issuing the stock, cash is going up. You're raising capital. When liabilities go down because you're paying principal, or equity goes down because you're repurchasing not somebody else's stock, your own stock, not somebody else's, okay? Cash is going down. When you repo your own stock, when you repay, not the interest, just the principal, okay? That's going to be considered an equity transaction, a financing transaction. Cash goes down. All right. Now, be careful of conversion of debt to equity, non-cash investing, okay, non-cash investing and financing. PP&E goes up, but cash doesn't go down. Be careful. Either debt goes up and or equity goes up. Supplemental disclosure. That is not on the statement of cash flow. All right, PP&E is going up, but we did not pay cash. Read carefully. If you issue debt or equity, supplemental disclosure, that is not on the statement of cash flow. Conversion of debt to equity. Conversion of debt, that goes down. Equity goes up. That is non-cash. No cash went in the door, out the door. Debt went down, but we didn't repay it. No, instead we gave them shares of stock because the owner of the debt had the right to convert that debt into equity. Okay, so that is a supplemental disclosure. Beautiful. We are kicking ass. So now we are ready to discuss in greater detail operating activities. So what's an operating asset again? All current assets except what? Cash and cash equivalents. So look for those accounts receivable, your inventory, your prepaids, your trading securities, not available for sale and not held to maturity. Look for the change in operating liabilities except interest bearing. Interest what? Financing. So if it's not a bond, note, debenture, mortgage, line of credit, whatever bearing, it's an operating liability. Deferred tax liabilities. That's a figment of an accountant's imagination. That is not an actual legal liability. That is non-interest bearing. Since deferred tax liabilities are non-interest bearing, that's an operating liability. Now, if they don't give you all the detail for the operating assets and operating liabilities, look for change in working capital. That one number many times estimates all of these items that you one by one you'd have to do. Now, working capital is really a net current asset over your current liability, right? So when working capital goes up, think you're on the buy side, cash is going down. If working capital goes down, you're on the sell side, cash is going up. So working capital is really a net current asset. What's the relationship between assets and cash? Inverse. Asset up, buy side, cash down, and vice versa. Why is operating so important in the real world? Because an analyst on Wall Street, the value of this company is generally not based upon accrual basis, a figment of accountant's imagination, net income. Now, how much cash can they generate from the core business? At the end of the day, the value of most assets is the sum of the present value of the future cash flow. It's all about the cash, okay? It's going to help you determine value, performance. Can you generate more business? How quickly? That's why we like to look at the cash conversion cycle. The quicker you can generate cash from your core business, the more impressed I am. The less risk there is of distress as well. Because if you could generate positive cash from your core business, you could use that cash to pay your interest, pay your debt as it becomes due, etc. All right, so a very important number in the real world. And to us on the exam. Do not have to memorize, folks. Okay, but I want you to be very familiar with the following items, okay? First of all, for my international students, we are learning US GAAP. US GAAP is very rigid, not the same rules as IFRS where they give you options. So anybody from IFRS world, you got to learn US GAAP for this exam. All right, interest paid, US is always going to be operating outflow, period. Interest received is going to be operating inflow, period. All right, so very important. All right, for my international students. But really operating activities, if we were to do the direct method, for example, if we were to do the direct method, where do you think you get most of your cash from? Customers, right? It's where you get most of your cash from, the cash you collect from your customers, right? But under US GAAP, when you receive dividends, when you receive interest, even though on the income statement, that's non-operating, under US GAAP, we put that in operating. Why? Because under US GAAP, we put interest paid as an operating outflow. So to offset that, and why do we make interest paid? Specifically on an income statement, you're taught, unless you're a bank, interest expense is non-operating, right? So why is it that on the statement of cash flow, interest paid is operating outflow, yet on the income statement, it's considered a non-operating expense unless you're a bank? Why is that? Because on the statement of cash flow, we're emphasizing the risk of bankruptcy. Look, if you don't pay that interest as it becomes due, you're rendered bankrupt, period. It's not optional like a dividend. IFRS says, hey, interest and dividends are kind of the same thing. They're not part of your core business. It's not like paying salaries and rent and marketing. It's not. It's a return to an investor. So if dividends are financing outflow, IFRS says, well, if you're not a bank, then interest should be what? A financing outflow. US GAAP says no. There's a big difference between dividends and interest. What's the big difference? You don't pay a dividend, not going to render you bankrupt, not even on preferred stock because it's not legally required. Interest is legally required. So we make that on the statement of cash flow and operating outflow. Same thing with taxes. You don't pay your taxes, you're in big trouble on multiple levels. And that's taxes paid. Okay, the income tax is not accrued for, paid. All righty. Now, trading securities around the world, what do you call that? Fair value through P&L. When you buy or sell it, I don't care, it's operating. If it's a current asset, it's operating. Okay, so international students, note the difference. All right, dividends is always going to be like interest, always going to be an operating item. All right, interest paid, always going to be operating outflow. Taxes paid, always going to be an operating outflow. What are your other major outflows? Your operating expenses. You got to pay your vendors, right? You got to pay your vendors. You got to pay your rent, insurance, utilities, all that SG&A. Notice something, under the direct method, you know what you don't see as an operating outflow? Depreciation and amortization, because that's not a cash expense. All right. Whether you buy or sell a trading security, also known as held for trading fair value through P&L, that's operating. But folks, when you buy or sell, if they call it available for sale, which you around the world call fair value through OCI, or held to maturity, also known as amortized cost, or it's an investment accounted for under the equity method because you have significant influence, or you're going to eventually consolidate all of those cash flow from investing. All of this would be cash flow from investing. When you buy it, it's an outflow. When you sell it, it's an inflow. Okay, the only thing that's operating we know is trading. All right, operating activities, core business. Ready? Major difference between US GAAP and IFRS. My US GAAP students don't even worry about this. US students, international, any type of interest, whether you pay it or receive it, any type of dividend that you, I should say any time you receive a dividend. Okay, be careful. Receiving dividends, when you receive it, assuming it's cash, when you receive it, operating inflow. But if you're on the pay side of that dividend, financing outflow. Around the world, IFRS students know dividends, generally they want to treat the same way as interest because neither one of them are operating expenses. Okay, so just be careful. Dividends received, operating inflow. No options under US GAAP. It's never an or. They tell you exactly what to do. Okay, dividends paid, financing outflow. Okay. So dividends paid. Good stuff, good stuff, good stuff. Investing activities. What's investing? Change in what? Non-current assets. When you're on the buy side, you're growing. And if you paid cash, obviously cash is going down. Assets up, cash down. But you don't always pay cash. Sometimes we issue a note. Sometimes we issue stock. Supplemental disclosure. Non-cash investing and financing. If you sell it, you're downsizing. You're selling off your PP&E. Not a good sign if you're not replacing it. Now, if it's old and you're replacing it, I got no problem. Okay, but when you're selling, you're downsizing. Now, if you receive cash, now you don't always receive cash. Sometimes people will give you a note, non-cash. All right, so just be careful. Did I receive cash when I sold it? Your selling price is generally going to be perceived as the cash received, unless they tell you the PP&E was sold and we got a note. Now, sometimes they'll tell you we sold the PP&E for $100,000, $50,000 cash, investing inflow. The other $50,000 is a note, supplemental disclosure for the note portion, the note receivable. Okay, so here when you sell it, assets down, cash up. All right, so any non-current asset. All righty, so with our investing activities, do me a favor, would you watch your, I used to say it to me, it's an old school term, watch your lip. What else is an old school term? You know, it was an Italian thing. What American things? I don't know, you're hollering. No one ever says you're hollering anymore. They say you're screaming, you're yelling. My father say, stop hollering. Maureen, what are you hollering at? Maureen, would you holler at that kid? He never shuts up. So, investing activities, change in non-current assets. Specifically, what does LIP stand for? We're making a loan. We are the lender, folks. We are the lender. We're making a loan. Investments. Okay. Intangibles. 2 I's in LIP. Okay. Long-term investments, intangibles. Remember, not trading securities though. And then people. All right. So watch your LIP. 2 L's, 2 I's, and the P. Remember, we're the lender. If you're the borrower, that's financing. Okay, so we're making the loan. We didn't receive the money, we paid. All right, so loans that are made to others. All right, so when you're the lender, that's an investing activity. Investing. When you're the borrower, then it's a financing activity. All right. And absent any other information, when you're borrowing, when you're issuing debt, a bond, a note, it's all interest bearing financing. Okay. Be careful with investments. If it's available for sale or held to maturity, that's going to be included in investing. What's not part of investing? The trading, the held for trading. For my international students, the fair value through P&L. That's operating. Okay. That's operating. Now, be careful. Available for sale is also known as what around the world? Fair value through OCI. Okay, available for sale, fair value through OCI. Held to maturity is also known as what sometimes? Amortized costs, synonymous terms. Okay, and then your PP&E and intangibles. Okay, are you buying or selling it? All right. Now, be careful with ordinary repairs and maintenance. If it's an ordinary repair, maintenance, that is operating outflow, okay? But if we capitalize it because it improves it, extends its useful life, improves its efficiency, okay? Major acquisition, you know, we expanded it. Anything that gets capitalized, that's investing outflow. Ordinary repairs and maintenance, operating outflow. If we capitalize it because it's extraordinary, all right, if we capitalize it, then it's investing outflow. All right, so beautiful. Let's get to an example. Ready? Slow and steady wins the race. First of all, when you work questions on the exam, let's say this is a multiple choice, so part of a task-based simulation. Never start up here because you have no idea what to do with this mountain of information. You have no clue. By the time you get to the question, you're now going to have to go back and reread, and you just wasted valuable exam time. No. We're going to get in the habit of, what do we call it? Legalized cheating. What do they want in this question? Determine cash flows provided by what? Investing activities. As soon as I see activities, what am I looking for? The change in non-current assets. If I'm on the buy side, outflow. If I'm on the sell side, inflow. But if and only if it involves what? Cash. Okay, cash. So here we go. We got the purchase of a copier, PP&E, non-current asset. All right, $40,000. So non-current assets just went in what direction? Up. Cash went down. Okay, but did we pay $40,000? Look at this. $23,000 we paid. The other was a note. We have an investing outflow, but not for $40,000. Even though the purchase price is $40, the investing outflow, cash is going down by how much? 23, not 40. The other 17, supplemental disclosure, non-cash investing and financing. Assets up, liabilities up for the other 17. That's an ugly 17. But the other 17, supplemental disclosure, non-cash investing and financing. Okay, assets up, no payable up, separate disclosure. Okay, purchase of available for sale, non-current asset. That's an investing outflow. How much did we pay? $100,000. So available for sale, my friends around the world, fair value through OCI, available for sale is up, cash is down by $100,000. Issuance of a long-term note to Orchard Company. We didn't issue it, okay? We're lending money to Orchard Company. It looks like we're borrowing. No, we made the loan, so we're the lender. We are the lender. We're not the borrower. If you issue it to the general public, then you are the recipient of that cash, okay? But we issued issuance of a long-term note to Orchard Company for $5,000. We're Arlington. We're the lender. This is not financing inflow. Okay? Lender. So be careful. That's investing outflow, the principal. Okay, so note receivable is going to go. Cash is going to go down by how much? $5,000. And that is the principal. Any payments for interest, we got to segregate operating outflow. All right, during the year, Arlington sold that copier, that non-current asset. They sold it. Non-current assets are going down. Cash should be going up. What's the selling price? They sold it for $36,000 after it incurred $8,000 worth of depreciation. So a lot going on here. First of all, my selling price, absent any other information, absent them telling you, selling price is generally your cash proceeds, okay? Unless they tell you you didn't get cash, whoever bought it from you gave you a note. They didn't give us a note, okay? They gave us cash. So selling price is $36,000. Now, just out of curiosity, we bought it for how much? $40,000. How much depreciation did we take? $8,000. That's called net book value, right? So your cost minus your accumulated depreciation is your net book value. So it cost us 40, accumulated depreciation 8, that's $32,000 net book value. So we got a $32,000 net book value. Therefore, we have a gain on sale of $8,000. Now that's going to make net income go up, but that's not part of our core business. And 36 minus 32 might be 4,000 on your planet. On my planet, if I'm getting the money, it's 8,000. Okay, but it's not my planet, it's your planet. So 36 minus 32 would be $4,000. Net income is up, but that's non-operating. So when we do the indirect method, that gain you're going to see is going to be subtracted from net income, because we are not in the business of selling our PP&E. We're in the business of selling our services or inventory. Okay. They also tell me Arlington sold the available for sale debt security, available for sale debt purchased earlier in the year for $80,000. Available for sale is what? Investing. All right. So that's investing activity. That's a non-current asset went down, so cash is going up. The selling price, unless they tell me otherwise, that's a cash inflow. Cash inflow, $80,000 investing. Cash inflow. All righty. Finally, Arlington received a payment of $2,100 on its long-term loan. We were the lender to Orchard. Now that $2,100 has to be segregated. How much is interest? How much is principal? Interest received, operating inflow. So when you receive a payment from a debtor, the principal portion, that's investing inflow. The interest portion is operating inflow. So we're receiving a payment from a debtor. They owe us money. We have to segregate. So how much of that $2,100 payment? Well, $100 is interest. So that's going to go where? Operating inflow. $2,000 is principal. The principal is what? Investing inflow. You see how I'm anticipating? You're going to anticipate as well. Okay. With practice and repetition, you're going to be on the lookout for these things. Okay. It's common where they try to trick people up. All right. So journal entries. If this were a task-based simulation, they could certainly ask us to do cash flow from operating, cash flow investing, cash flow financing, but they could also ask for journal entries along the way. So when we bought the copier and our cost was $40,000, that was not the cash paid. The cash paid, this is the investing outflow. Okay, this is non-cash supplemental disclosure. It's called non-cash investing and financing. A non-current asset went up by $17,000, but we didn't pay $17,000 in cash. That we obviously issued a note. We were the borrower. Okay. Now, sale of the copier. When we buy it, non-current assets up, a certain amount of cash down, but the key thing to take away is the cash, we didn't pay all cash. But when we sold it, absent any other information, the selling price, that's your cash received. That's an investing inflow. When you sell it, accumulated depreciation is a contra asset. Normally has what kind of balance? Credit. How do we get that off the books? With the debit. Credit PP&E for our original cost, and then net income is impacted, goes up by $4,000 in that gain. When we do our statement of cash flow, you don't have to copy this down now, but I'm telling you, if this were the exam, okay, depreciation, anything we accrue for, expected credit loss, what we used to call bad debt expense, warranty, anything we accrue for, we add that back because it made net income go down, but no cash went out the door. Add back your losses, subtract your gains. Why? Not part of our business. It's not that it's full accrual versus cash base. It's not. It's not part of our core business. Okay, so that would appear on the statement of cash flow, indirect method. Direct method, we'd ignore it altogether. Okay, now, remember, trading securities, operating, pretty much any other long-term investment, whether you want to call it available for sale, you want to call it held to maturity, amortized costs, you want to call it equity method, or you want to say, hey, we have control and we're going to consolidate. All of these change in non-current assets, that would be investing activity. Okay, so that's what we're looking for. So purchase of available for sale, non-current asset up, cash down, and the cash matched our purchase price. That is investing outflow. Later on, when we sold it, the cash inflow, investing inflow. All right, now we paid 100, we only sold it for 80, so we have a loss on sale. So going back to my prior slide, what would be subtracting that gain of $4,000? What are we going to do with that loss? That loss, when we do the indirect method of $20,000, we would add that loss back. It made net income go down, but we're not in the business of selling investments. It's not what we do. We happen to have investments, okay? Walmart, you name it. Apple, they're buying stocks and bonds of other companies just like we are, all right? But they're not in the business of doing that. Now, if you're a hedge fund, mutual, that's a different story. Then that's your core business. If you're in a bank, you're in the business of borrowing money, paying out interest, lending it to somebody else, hopefully at a higher rate, and they make money on the spread. Interest for a bank is operating. For everybody else, it's non-operating. Okay, let's see what else we got. All right, that loan, we were the lender. When you're the lender, it's an investing activity. When you're the borrower, it's a financing activity. Okay, we were the lender here, so it's an investing activity. All right, investing activities, we just got to make sure we segregate the principal and the interest. So when we made the loan, we're the lender. That's investing outflow. And this is the principal, all right? So when we receive principal, that's going to be investing inflow. So while we got a check for $2,100, that is not all investing inflow. Okay, the principal portion, that's investing inflow. The interest portion, that's operating inflow. So we got to make sure when we get a payment from a debtor, we got to segregate the principal and the interest, just like when we make payments. If you're the borrower and you read principal, that's financing outflow. When you pay interest, that's operating outflow. When you're the lender and you receive principal, investing inflow. When you receive interest, operating inflow. So be careful. A loan, am I borrowing or lending? Okay, so same thing with stock. You're buying stock. Is that an investment? I don't know. Is it my own stock? Because if I'm buying my own stock, that's financing outflow, my own stock. Somebody else's stock is an investment, assuming it's not a trading security. Okay, so summarizing all those transactions. You ready? Don't give me any lip, Pete. Investing activities. Don't give me any lip. Change in non-current assets. Do not give me lip, boy. And that's exactly what my father used to say. And back in the day, there was a belt hanging up with my name on it. And it normally wasn't the leather side either. You got to love it. Old school. So PP&E, there's your P in lip. Are we paying it or receiving it? Okay, your PP&E. Your investments. Are you buying it or selling it? Your long-term investments, what you paid versus what you received. Inflow versus outflow. Okay, loans, the principal only, and we're the lender. So when we made the loan, outflow, the principal back, inflow. Ultimately, we had net cash used. Hey, a -10, is that bad? No. When your cash flow from investing is negative, that means you're buying more investments than you're selling. You're growing, all things being equal, okay? Now, financing activity. Woo, baby. You guys loving this stuff? How's it going? Quinn, Megan, how am I doing out there, Megan? Can you hear me, Megan? Can you talk? Can you tell yourself off?
Of course I can hear you, Pete. Who can't hear you, Pete?
Let's go. Are you loving this, Megan, or what?
I do. I love to talk about the statement of cash flows. It's like my favorite thing.
Yeah, well, I love talking about your bank account. Go ahead.
Cash is king, man. So who doesn't love the statement of cash flows?
This is true. She's making a point. Megan is making a point. She's making CPAs. Quinn, what do you got to say about this? How you doing with this, salesman? You getting all this stuff?
Let's
go. You gonna sit for the CPA?
We're gonna start with the EA, Pete. Then we're gonna do the CPA.
Listen to me. If you can't be a CPA, then you got to marry a CPA. Isn't that right? Quinn, am I right or am I wrong?
You're usually right.
Thank you very much. Don't ever disagree with me. All right, financing. You ready? Change in our own debt with a borrower, and the change in our own equity, not somebody else's stock, our own stock. Okay, could be common equity, could be preferred equity. All righty. So liabilities, there are two types: operating liabilities, financing. How do you know it's financing? It's interest bearing. Notice I wrote the N before the I. Interest bearing. And what's the buzzwords again? Note, bond, debt, debenture, mortgage, line of credit. All right. Negotiated, interest bearing, financing liability, the non-interest bearing. Don't tell me about short-term, long-term. There's lots of short-term liabilities that are financing because they're interest bearing. Okay. So whenever equity goes up, we're raising capital. Cash goes up. When debt or equity goes down, and I'm talking about the principal on the debt, we're repaying or repurchasing our own stock. Cash goes down. Why would a company buy back their own stock? Because they got free cash flow and they're looking at the world of investments out there and they're like, shit, our stock is trading at $20 a share. We think it's worth 80. Hell with buying somebody else's stock or buy PP&E. Let's just buy back our own stock. All right, you're allowed to do that. Now, no officer, director, insider can trade on material, non-public information, but the company can certainly trade on its own behalf. So if you see a company buying back their own stock, you might presume, hey, they know something I don't know. They think it's a good buy it. Maybe you want to buy it with them. So the question is, do they really think the stock is undervalued? Maybe they want you to stock price is undervalued. So if they buy it, you'll buy it with them, driving up the stock price, putting their options in the money. So we wonder. I wonder who. That's when Quinn was growing up. That was a very popular song when he was in college. All right, so financing activities, you ready? Anytime we see the word negotiated or it's any kind of interest bearing, it's got interest tied to it, then that's going to be, you see the word debt, interest bearing. If you issue the bonds, that is an inflow, you're raising capital. When you retire the bonds, outflow, just the principal though. All right, proceeds from borrowings, inflow, repayment, principal only, outflow. Okay, interest is always what under US GAAP? Operating, no options. Issuance of our own stock, inflow, common stock or preferred stock. We buy it back, outflow. What do we call it when you buy back your own stock? When you repurchase your own stock. That is what? Treasury stock. When treasury stock goes up, cash goes down. When treasury stock goes down, you reissued it, cash goes back up. Cash dividends paid, not property, not stock, and not merely declared. Not property, not stock, and not merely declared. How do you know if a dividend was paid? Find me beginning dividends payable. I'll make up a number. Let's say beginning dividends payable per a comparative balance sheet. Last year's ending, 5. Beginning dividends payable. From your statement of retained earnings, find me the dividend declared. Let's say that's 10. What's the total amount we owe? 15. You either paid it or you didn't. You either paid it or it's not paid. If it's not paid, where is it? Ending dividend payable. So if ending dividend payable, let's say, is 9, 15 minus 9, then we must have paid how much? 6. That's what you do with every expense on that income statement. Rent, salaries, insurance, whatever it is. Tell me the beginning balance. Tell me the current year expense, the beginning balance for that payable, plus the current year expense we accrued for. This is the total amount we owe. And then you either pay or you didn't. How do you know if you didn't pay it? That's in the ending payable. Subtract the ending payable, and there's what you paid. All right. Equity, our own stock, not somebody else's stock. Issuance of our own stock. Be careful. Not somebody else's stock. When you buy somebody else's stock, that's an investing. Okay. And remember, this equity is our own, not somebody else's. Now, I'm now just going to refer the way we teach at UWorld. Like, we don't just like, I'm going to remind you. And let me just insert a slide for a second. Like, for example, I would remind you, like, common equity. If it's no significant influence, okay, that generally means you own less than 20%. Okay, that we call a trading security. Okay, no significant influence. All righty. If we have significant influence, we own between 20 and 50%. We use the equity method of accounting. That's cash flow from investing. Trading securities, current asset, cash flow operating. If you have control, what's evidence of control? Generally, you own more than 50%, but there are exceptions where you don't own more than 50, but you still have control. That's also cash flow from investing when you buy and sell it. Okay. If it's preferred equity, that's a trading security. Under US GAAP, if we buy somebody else's preferred equity, again, we're on the buy side. We're investing. We're not issuing. Buy side, we're investing. If it's preferred equity, that's a trading security, also known as held for trading. Cash flow from operating. Debt could really be anything. Okay, we buy the debt. We're the lender. Okay, so it's an investment. We're buying. That could be trading, cash flow from operations. That could be available for sale, cash flow from investing, or it could be held to maturity, also known as amortized cost, cash flow from investing. All righty. So just keep that in mind. All right. So we cross-reference between lectures to remind you of rules we would be discussing elsewhere. Okay, but we've been mentioning these investments. They're covered in the balance sheet lecture in detail. All right, so now let's take a look at another question. You ready? Start with the question stem, not the facts. They want the cash flow provided by what or used by financing. So immediately, what am I thinking? Change in my own debt. I'm the borrower, not the lender. and the change in my own equity, raising capital. And if it's a dividend, it's got to be not just declared, and it can't be property. All right, so we have the following transactions. We issued 80,000 shares of common stock for $800,000. It's a financing inflow, folks, financing inflow. Now on the balance sheet, we got to segregate. The stated capital is going to go up, $250 per share, 80,000 times 250. 80,000 times 250. Well, stated capital is going to go up by 200,000. Additional paid in capital in excess of par, well, that'll go up by the balance, 600,000. But overall, we got a financing inflow, 800,000. But on the balance sheet, we have to segregate. We issued bonds. We are the borrower. So that is a financing inflow, and that is the principal. During the year, we paid $100,000 for the repurchase of our own stock. Treasury stock up, cash down. Financing outflow. We paid $220,000. Okay. Excuse me, $100,000 for the repurchase stock. Then we paid $220 on the bond. Now I got to segregate. How much for principal? How much for interest? The $200,000, that's principal, financing outflow. The $20,000 for interest, that's going where? See, we anticipated operating outflow. So then we look, and whoop, there it is. There's our journal entries, right? Could be part of a task-based simulation. So when we issued the stock, that debit to cash, financing inflow, 800,000. And then on the balance sheet, we have to segregate stated capital from additional paid in capital. Okay, when we repurchase our own stock, treasury stock up, cash down. What is that? Financing outflow when you repurchase your own stock. If you buy a different company's stock, investing outflow. But that's our own stock. Okay, so emphasize, I don't know, buying or selling stock, where does that go? It depends. Whose stock is it? You're always anticipating that. Same thing with debt. Am I the lender or am I the borrower? Here, I'm the borrower for the debt. I'm the borrower. So I issued bonds, financing inflow. It's a way to raise capital, credit your bond payable. Whenever you make a payment, we got to segregate what? The principal, financing outflow, from the interest, operating outflow. So long as that interest has been paid, $220, that $20,000 has not been accrued for, that $20,000 has been paid. It's an expense and it's been paid. If you've only accrued for it, hey, is there interest expense on a non-interest bearing loan? You bet there is. If there's no stated interest rate, if it's a zero coupon bond, there's still interest on that. You're just not paying it in cash. You're accruing for it over time. You would see that on the income statement, but not the statement of cash flow. Okay. A zero coupon bond, you're not paying coupons. When you repay the $1 million at the end, some of that's principal, some of that's interest. All right, the present value of the future cash flow, that's the principal. Anything above and beyond, that's the interest that you'll accrue for over the life of the bond. All right, but there's no coupon payment. If there's no coupon payment, there's no operating outflow. All right, operating cash outflow when, if a coupon is paid, when, if it's paid. If it's non-interest bearing, then there's no coupon paid. You'll still book interest expense. How can we book interest expense if there's non-interest bearing? Because we're not cash basis, we're accrual basis. You'll still accrue for that interest. How the hell do you accrue for interest expense? The beginning carrying value of that liability times the market rate when you borrowed the money, the market rate at issuance. The carrying value of that liability at the beginning of the period times the market rate at interest, that's your interest expense. Okay, that's what's on the income statement. Now, whether or not that gets paid right now is depending upon whether it's coupon bearing. If it's coupon bearing, the face amount times the coupon rate, okay, that's the interest paid. That's what you'll see on the statement of cash flow. All right. So if a bond is issued at par, no discount, no premium. Again, if a bond is issued at par, no discount, no premium, then the coupon paid will equal the interest expense. And we'll go through that in great detail in the bond lecture. Okay, but if you issue a bond at a discount, your interest expense is actually greater than your coupon paid. Interest expense on the income statement, coupon paid, statement of cash flow. If you issue a bond at a premium, Well, that's good news. That'll reduce your interest expense, and that'll be less than the coupon paid. All right, so what's on the statement of cash flow is the coupon paid. The coupon paid face times the coupon rate. Okay, that's stated rate. All righty, so now to summarize, cash flow from financing. Again, change in our own debt and equity. We're the borrower, not her. And the equity is our own, not somebody else's. Proceeds, inflow, paid, outflow. Proceeds, inflow, paid, outflow. Net cash provided. Now, in the real world, should that be positive or negative? A lot of that depends upon the cost of borrowing. A lot of that depends upon the cost of capital. Is it a good time to raise capital? Is it cheap, or is it a bad time to raise capital? Your weighted average cost of capital is your hurdle rate for success. If you can raise capital at 2%, I'm pretty sure you can get a return on investment greater than 2. But if you got to raise capital at 12%, I don't know if it's such a good time, because you're going to be able to confidently get a return greater than 12. That's your hurdle rate, right? All right. So, statement of cash flow, indirect method. You ready? Here's your date for tonight. Technically, statement of cash flow could be done directly or indirectly. Same result, different format. All right, same exact result, different format. What we are responsible for is the indirect method, a reconciliation of accrual basis net income. And folks, net income is not the same thing as operating income. Net income includes operating, non-operating, and discontinued. Okay, we want to reconcile accrual basis bottom line net income to the cash actually generated from the core business. All right, so here is your date for tonight. You're going to write it with me, because look, the way we do things at UWorld, we're not reading a script. Do I look like I'm reading a script to you? No. So what we're going to do is, what I write, you write. Because you can't watch me on a treadmill and think you're going to lose weight. If you sit down and watch me, what the hell is that going to do for you, right? So you are going to put the pen to the paper, because what you write, you will remember. So here we go. Let's make our flashcard together right now, together, step by step by step. Here we go. You ready? You start with net income per your income statement. You're going to add back depreciation and most amortization. You're going to add back expected credit losses, bad debt expense that you merely accrued for. Okay. You're going to add back your losses. Why are you going to add back your losses? Main net income go down, but it's not part of my core business. So these are non-cash. So you're adding those back. This is non-operating. Add back losses and subtract gains, and the amortization of a bond premium. Bond premiums are good news. Okay, when a bond is issued at a premium, you got $1 million bond, they give you $1.1 million, they give you an extra $100,000. That extra $100,000 you can't immediately record as a gain, because that would violate the matching principle. So instead, you'll learn in the bond lecture, we take that extra $100,000, we spread it out over the life of the bond by reducing interest expense and making it less than the coupon paid. That reduced interest expense made our net income go up. That's not part of our core business. We're not in the business of issuing bonds at a premium. So these are non-operating items. Okay. Then you are going to subtract your change in operating assets, all current assets except cash and cash equivalents. You're going to add your change in operating liabilities, non-interest bearing. Here we've got an inverse relationship. Here we have a direct relationship. If the operating liability goes up, add it. If an operating asset goes up, subtract it. Opposite direction. And therein lies the cash we generate from our core business. We just went from accrual basis, bottom line net income, including things that are non-operating, to cash basis, only core business. How much cash can we generate from our core business? All right. So there is your date for tonight. The more times you write it, you hear it, you read it, you'll remember it, you'll take the exam, and then you can forget it. So there is your date. Whatever you're going to do, cancel those plans. So here it is, nice and pretty. All right. So you got to know the indirect method. So comes where? Per the income statement. You're going to add back your depreciation, non-cash expense. You're going to add back your amortization, not all of it, most of it. Most, not all. Amortization of a bond premium gets subtracted. We're going to add back our losses from sale of assets, any kind of write down, any kind of write off, any kind of expected credit loss. Those things made net income go down, but not part of our core business, and or it's accrual basis, not cash basis. Okay, we're going to subtract equity earnings from an investee under the equity method. So long as the equity earnings is greater than the cash that's actually received, okay, we got to back that out. That made net income go up. Our percentage, we'll learn about that in another lecture. This is when you have significant influence and you're doing what's called the equity method of accounting. Dividends are not income. What's on the income statement is your percentage share of their profit. Well, that doesn't mean you have, if you don't have the cash, you got to back it out. Amortization of what? A bond. That made your interest expense less than your coupon paid. That premium, the difference between the interest expense and the coupon paid, that reduced expense made your net income go up, not part of your core business. Any gain from the sale of an asset, non-operating, not part of your core business. Losses, gains, not operating. Okay, now we're going to go from accrual basis to cash basis. We're going to subtract the change in operating, the opposite. This minus sign means do the opposite. Add your change in operating liabilities. Keep the sign. If it goes up, add it. If it went down, subtract it. And if they don't give you all this detail, then subtract your change in working capital. The subtraction sign means what? Do the opposite. If working capital went up, subtract it. If it went down, add it. What does that get us? The cash provided by what? Our core business. Here's full accrual basis, including non-operating items. Here's the cash from our core business, what we do all day. Let's go. All right, so indirect method, we're going to know it inside and out. So we don't like accrual basis net income, and net income is also not the same thing as operating income, because net income includes operating, non-operating, your gains and losses, and discontinued operations. What's a discontinued operation, by the way? What's a good example? You going out on a Friday and Saturday night having a good time while you should be studying for the CPA exam, that's an extraordinary item. Okay, that shouldn't be happening. So that's a discontinued operation. You're going to discontinue that, and you're going to be studying, hanging with me. I'm your only friend. Nobody likes you but me anyway. All you ever do is study. It's you and me, baby, against the world. We don't need them. It's all about us. Get your CPA. You don't need nobody. They need you. That's right. All right, so we're going to reconcile net income, make all of our adjustments to get to the cash generated from the core business. What's a major red flag? If net income is going up, but period after period, I don't see the cash being generated, then I don't believe what's on your income statement. Earnings is low, okay? So that's the real world analysis. I don't believe it. Okay, now all of those adjustments from net income to operating cash flow, okay, some of them are because those items are non-cash, depreciation, amortization. Some of those items are non-operating, but some of those items take us from full accrual to cash basis, okay? So we're looking at the change in operating assets. We subtract the change. Watch your signs. Do the opposite. Add your change in operating liabilities. Keep the sign. If it went up, add it. If it went down, subtract it. Okay, just make sure it's an operating asset, operating liability. Okay, you see the word debt, even though it's short term. You see the word debt, financing, even though it's short term. Okay, investing and financing can only be done one way. Okay, the direct or indirect method only affects how we calculate cash flow from operating activities. Direct method, you take cash collected from customers plus cash collected for interest, cash collected for dividends, cash collected on the sale of trading securities. Then you subtract cash paid for all your operating expenses, your vendor, your salaries, your rent, your insurance, your utilities, your marketing, all that stuff. Interest paid under US GAAP, operating outflow, taxes paid, operating outflow. Alrighty, you buy a trading security, operating outflow, you'll get cash flow from operations. Same number you'll get under the indirect method, but just the way we do it is differently. When you do the indirect method though, remember what we started this with, there's a supplemental disclosure that's required. You gotta show those investors on Wall Street, supplemental, the cash that was actually paid for interest and the cash that was actually paid for taxes. Those lines only show up if you do the direct method. The indirect method doesn't show cash paid, cash received. Cash received minus cash paid, that's direct method. Net income adjusted to operating cash flow, that's a reconciliation. That's the indirect method, okay? Let's see. So here is a sample. We got net income of $140,000. Okay, here's our income statement. So revenue, cost of goods sold. How much of that did we actually pay to the vendors? Then we got our operating expenses, depreciation, non-cash, credit loss expense. It's a loss, non-operating, like bad debts. Okay, then we got non-operating items, a gain, not part of our core business. Amortization of a discount. A discount is what? Bad news. That's a loss. What do we do with losses? We add them back. All right, so this is our net income, $140,000. This is our starting point. Even a cash flow, indirect method, that's where we start. So let's review. What are we going to do now? I'm going to add back my depreciation cash expense. I'm going to add back any losses, credit loss expense, write-offs, write-downs. We add those back. All right. And what do we do with gains? I subtract that gain, not part of my core business. A discount, when you sell a bond at a discount, I borrowed $1 million, but they only paid me $970. That sucks. I got a $30,000 loss. When you amortize that loss, you amortize that discount, that'll make your interest expense greater than the coupon paid. That higher expense made net income go down, but there's no additional cash being paid. All right, so we add that back. A discount is a loss. You add back the amortization of a bond discount. All right, let's see what else we got. They tell us, you ready? Accounts receivable, that's an operating asset. Inventory, operating asset. Accounts payable, operating liability. Taxes payable, operating liability. What's the thing we do with operating assets? Do the opposite. If it goes up, subtract it. If it went down, add it. What do we do with operating liabilities? Keep the sign. If it goes up, add it. If it went down, subtract it. Accounts receivable increased by 80. So what am I going to do? Subtract that 80, the opposite. Inventory increased by 30. What am I going to do with that 30? Subtract that 30. Operating liabilities, direct relationship, decreased by 20, keep the sign, decreased by 20. Taxes payable, increased by 40, add the 40. Change in operating assets, change in operating liabilities. Here we reverse the sign, we keep the sign. If it went up, add it, went down, subtract it. Okay, operating assets is the opposite. All right, so now we are ready to do our indirect method. Now, in a task-based simulation, you know, they can break this into different parts. Okay, why are we adding back depreciation expense? Because there's no cash outflow. Why are we adding back a bond discount? Because that is the amortization of that bond discount, that loss, little by little. Okay, no cash went out the door for that additional expense. The actual expense is represented by the coupon paid. The only time the interest expense on the income statement equals the coupon paid is when the bond is issued at what? Par. If the bond is not issued at par, or if it's a zero coupon bond, any time other than par, the interest expense is not the same thing as the cash paid for the coupon. Okay? Credit loss expense. What do we do with losses? We add them back. Why? Non-operating. Gain on the available for sale security. What do we do with that gain? We subtract that gain. Why? Not part of our core business. Gains and losses by definition. A gain is like revenue. It'll make net income go up. But revenue is your core business. Gains are not. Losses are like operating expenses. They'll make net income go down. But losses are not part of your core business. Operating expenses are. Okay, now obviously they could ask you for journal entries along the way. When receivables go up, there's no cash received yet. So if accounts receivable goes up, there's no cash received yet. That's why we do what? Subtract that increase. That's accrued revenue. We book the revenue, but we don't have the cash yet. So when accounts receivable goes up, what do? We reverse the sign. We subtract it. You do the opposite with operating assets. Inventory. We're on the buy side of inventory. Inventory increased. We're on the buy side. Anytime you're on the buy side of an asset, you're thinking cash goes in what direction? Down. Inverse relationship. Inventory up, cash down. Okay. So we've got an increase. An operating asset went up. So what do? The opposite. We reverse the sign. Accounts payable, operating liability. Decreased. You repaid. You repaid. All right. So if you're repaying, accounts payable down, when a liability goes down, cash goes down. If it's the principal, okay, not the interest. So accounts payable down, What do we do? Keep the sign, subtract. Operating liability down. Operating liability down. Cash down. Operating liability up. Cash up. Income tax expense. Ready? You're accruing for your tax expense. You didn't pay it yet. It increased by 40. So when operating liabilities go up, what do? Keep the sign. You add it back. You accrued for the expense, but no cash paid yet. When you're debiting income tax expense, but you're not crediting cash, that means you accrued for the expense. No cash paid. Bottom line is operating liability up. What do? Keep the sign, add it back. Okay, when you accrue for an expense, there's no cash paid. By the way, just as an FYI, if you take a beginning payable plus the current year expense, that's the total that you owe. Isn't that right? Subtract the ending payable, and therein lies the cash that you must have paid. Okay, just like we did with dividends earlier. Take the beginning payable, add the current year expense, that's the total you owe. And then either you paid it or you didn't. So if it's sitting in the ending payable, you didn't pay it. Okay, the balance you must have paid. Okay, so there's our cash flow from operating. Heavily tested. Look, I don't know if this is going to be a task-based simulation, but boy, statement of cash flow lends itself well, doesn't it? Because you got all the different parts. So what do we do with depreciation? Add it back. A discount is synonymous with a loss. That amortization, we add it back. Credit loss expense, we add it back. Gain, non-operating, we subtract it out. Okay? These adjustments are all per what? The income statement. All of these adjustments now are per the balance sheet, the change in our operating assets, change in operating liability. You got an increase in operating asset up, so what do? Subtract it. Operating asset up, what do? Subtract it, okay? And obviously the brackets mean subtract, doing the opposite. Accounts payable down, keep the sign. Operating liability down, keep the sign. Increase, operating liability up, keep the sign, add it. Net cash flow provided by your operating. Now, in the real world, I think pretty, decent quality. Our cash flow from operations is a little bit lower, but it's not significantly lower. What I wouldn't want to see is that disparity growing. Okay, I'd like to see periods, where it kind of alternates. But overall, the growth in net income and the growth in operating cash flow, they should be moving together. Not at the same time, because timing difference between accruing and cash. But overall, over time, I hope they're growing together. Quality of earnings. I don't believe what's on your income statement if I don't see the cash being generated from your core business. Okay, now the whole statement of cash flow, task-based simulation, baby. You ready? 1 of 3, cash provided by what? Operating. 2 of 3, cash provided by what? Or using. Lastly, cash flow from we get our change in cash. Now, this change in cash has got to equal what we have on the comparative balance sheet. Otherwise, you screwed something up. You then add your beginning, there's your ending. You add your beginning, there's your ending. But this is our check figure. I'm going to know the answer to my change in cash before I even do the statement of cash flow if they give me a comparative balance sheet. Okay, these numbers are coming from where? Your balance sheet. Last year's ending. Last year's ending is this year's beginning, last year's ending, and then you've got this year's ending. You're going to get that information, so you'll know you're changing cash. If you don't get that number, you did something wrong. Woo, baby, let's give birth to a CPA. So what I want to do now is I got to get some coffee and take a break. My buddy Quinn, he's ready to take you through a little bit about who UWorld is, what we could do for you, how we could sign you up and get you a discount, whether it's at your school, your firm. If you don't currently have a discount at your school, it did, because we're the new sheriff in town. All right, so Quinn's got you all set up. Quinn, my friend, are you there, Quinn?
Let's go. Thank you, Pete. And thank you guys for hanging in there. Dynamite session so far. Let's talk about how it can translate into you passing the exam. Again, UWorld. Leader in the area, 90% pass rate. Please, be mindful, compare your national pass rate to that and think about all the time and energy you are putting into this effort. Let's talk about the program and how it's going to help you pass. First of all, we've got a great legacy. In addition to Peter and Roger Phillip as our global lead instructors. We do have the legacy of the Roger acquisition, and then the Wiley acquisition, and then recently Surgeon, and then Peter. We're committed to owning this space. So next slide, sir.
You got it. You got it.
World plus Wiley. All right. How do you do it? Time management is key. So we start off during the onboarding with a study planner, completely customizable, allows you to literally allocate which days and how many hours each of those days you're going to study, and then to put that into your schedule. We recommend sharing this with your loved ones, those that are in your personal circle as well as your professional circle. Let your supervisor know, let your manager know. But you can literally adapt this on the fly. So if you get brought into an engagement or you've got a vacation coming up, you can calibrate it up or down. We always recommend doing 4 hours, as you'll see here. This 4-hour exam, you might as well practice how you're going to be tested, and that's what we do. And this actually happens during our onboarding experience. So as a UWorld customer, you literally have an engagement with one of the team members that's going to learn about where you are in the process, when you want to study, when you want to sit for the exam, and work that out with you starting right here. So this is you driving in the system. But time management's key. We accomplish that with the study planner. Yeah, like Pete's saying, we're going to ask you, how did you do in intermediate? Were you a C student? Were you an A student? That'll help calibrate how many hours are going to be needed to get you ready. So step 1, study planner. Step 2, all right, you need quality instructors. We've got a great full team of them. So you've got 2 of them here today, Dr. Megan Burke behind the scenes, and then the CPA maker himself, Peter Olinto, right up front. And you'd think if you were a CPA review provider, or if you were in that business, that you might have worked in public accounting. Well, that is the case with all the UWorld instructors. And you'll see that half of them have not only gone on from public accounting, but have gone on to get their PhDs. And Peter's highlighting a couple of these to highlight, if you're in the academic world and you've taken intermediate or tax, you might recognize the Greg Carnes and Suzanne Youngberg. They're leading authors on the Wiley textbook. So anyway, you've got a cadre of instructors that have filed the paperwork, passed the exam, half of which have gone on to become PhDs. And you know that college instructors are great at differentiating instruction. 5 sets of videos in the system, okay? And you're going to see them presented just like you see Amber right here. Clear, concise. She's not going to be reading a script, but everything that she's doing is going to be aligned to the same organization and topics featured in the study guide, which is right to the right. These videos, on average, 17 minutes. It's the Netflix formula. It's not going to overwhelm you. It's going to give you a bite-sized amount of content that you can review, or many of our candidates actually will listen to these as podcasts, especially on the areas that are challenging for them. So 17 minutes in length. They're going to correspond with the study guide. Great way to get through the material and to refresh and review if you're having challenges.
And Quinn, I just want to emphasize, you would think that that's logical, like every course, the lectures would align with the study guide. Not true. There's another course out there where the lectures are not aligned to the study guide. It's like, where the hell are you? And then the lectures off on that script that's not aligned with the study guide. I don't even know what that's about. But do your due diligence, check that out.
It creates a disjointed learning experience, and you're not going to have that here at UWorld. Everything, this is literally going to make a learning circle. So the next slide. Right, here we go. So you're going to be spending, the bottom line of why we're showing this to you is you're going to be spending a lot of quality time with those instructors. You want to make sure that they're engaging and they're presenting you quality and they connect with you, all right? And that the format works. The other place you're going to be spending a lot of time in the Q bank. And after you answer a question, this is what the answer response looks like. It's clear, concise, and consistent. Under 300 words, you have basically a delineation of why the right answer is right and why the wrong answer is wrong. You'll literally see that B, C, D down there. And at the bottom of that, including the visual, they've got a supply and demand chart there. You're going to get a thing to remember. This is great. This is like the cliff notes for the question. The thing to remember is the overall concept that's being applied and tested. And if you're ever like, hey, why am I getting this question in the first place? Well, look, right below it, you're going to see something called a representative task. That's literally the blueprint designed from the test maker, the AI CPA. And if you still need more help, well, let's go back to that learning concept and that learning circle concept that we just described. You'll have a link back to the video, back to that section of the study guide at the very, very bottom. But the other thing that's featured here, and it's hard to see, but on the left-hand side, after the answer responses, you're going to see the percents of respondents also in the system and what they selected. So maybe you didn't get it right. Okay, that's fine. That's just a starting point to kind of calibrate back. But this will give you contextual information about how many others in the system right now also selected your answer, and essentially how far is the learning gap for you to kind of come back to. So yeah, expect clarity, consistency, and quality. We value your time in the system. You're not going to get some cursory response that says, oh, this is an old outdated question. Don't expect this on the exam. Not here, not at UWorld. This is a premier offering and a key differentiation for what makes UWorld so successful. The next one is featured on the next slide. Nobody else has anything like this. The Smart Path literally is your AI-powered gradebook. What's happening here is really important. I'm going to try to break it down slowly and clearly for you. On the left-hand side of the chapters, you're seeing the scores, okay, how I'm progressing. You'll see I've got blue in some chapters, I've got green in the middle too. That's tracking my progress towards a green target. And that target is available for me to see exactly what level of score do I need. Okay, it's not always 100%. Actually, in many cases, it's not. On the right-hand side, the counterbalance to the score is a number of questions. Okay, so again, number of questions available. How many have I attempted? I can see my progress bar, again, building towards the green target. And this is the essence of the UWorld system. We're trying to keep you in the sweet spot between the score and the number of questions. It's not like, hey, I got 100% on 5 questions. No, that's not going to fly. It's calibrated off of these targets. The green targets are calibrated off of folks that have used the exam and passed it on their first attempt. So it's a combination of volume and performance. It's an efficacy model. So if you want to just blow up and live in a Q bank for the next 10 weeks, you're fine and free to do it, but this isn't the program for you. If you want to accentuate your strengths and have them marked out very clearly, and also identify the areas that need more work for you, or go in your own pace, in your own sequence, that's completely available to you at UWorld. Now, on the right, you're seeing Pete is highlighted or circled, getting close or target met. Now, listen, the bottom line is, through your study program, if you can get 75% or more of these chapters, these areas to say target met, ladies and gentlemen, that equals the 90%. So believe me, UWorlders get really excited when they come in and they see the green thumbs up target met, because they know literally, statistically, the system is telling them, guess what, my friend, you are ready for the exam. And I want you to think about that for a second of what that means when you go into the Prometric Testing Center, knowing that the system has told you you've met the same competency level, the same performance level of those that have passed the exam the first time. That's a good feeling. No longer are you wondering, oh man, did I do enough questions? Did I do enough, in the Q bank? You don't need to do that. It's efficacy. It's the right amount of performance with the right amount of questions. That's the sweet spot, and that's what the Smart Path does for you. All right, number next, here we go. Well, after the multiple choice questions, we all know task-based simulations are challenging. They'd be challenging if it was an open book exam. I mean, this is the work, right? So what's going to happen here is Megan, who's hiding out here in the background, and please feel free to chime in, is going to walk you through 2 things. The first thing is there's going to be a set of videos, strategy videos, where Dr. Burke is literally going to walk you through how to deal with the task-based simulation question. How do we break it down? How do I deal with the journal entries? How do I deal with the exhibits? Do I open them all up? No, I don't. But she's going to give you the specific strategies on approaching the task-based simulations. Next, we go over into the Q bank that we just talked about. And in those answer responses for the task-based simulation questions, guess what? Detailed video explanations, how to set up and break down specific questions. So if you want, you get stumped on one and you want to see literally how and where to break it down and where did you go off and how to correct it, that's exactly what you're going to get from UWorld. So that's videos number 3 and 4. Number next. All right. Yeah, listen, there's always going to be challenge areas, whether it's statement of cash flows like we're covering today or EPS, diluted EPS, whatever. This exam is filled with lots of areas that are challenging. Well, we've got you covered. So if your SmartPath is showing an area that you're not progressing, check out the CPA Bootcamp, okay? Ladies and gentlemen, this is a deep dive. Forget about the moment of the 17-minute video. Video number 4 here is doing a deep dive of 2 hours on a single topic, covering both multiple choice, task-based simulations, and exam day tactics. So if you want to check them out, get your phones out and click on the boot camps. All right, this is a great way for you to see exactly all the topics. On average, we do about 8 to 10 of these a year. We've been doing them for the last 3 years. So there's a whole volume, a whole archive available to you. And if, again, this is for those challenge areas on your SmartPath that aren't moving forward as fast as the rest, the boot camps are a great resource for you to check out. Single topic, deep dive. Yep, go ahead, Pete.
Yeah, I just want to emphasize, some of these are free because we want to earn your business like we're doing today. Obviously, there's a whole library of these videos for just paying customers. So I just want to clarify, not all of them are available for free. We make a sampling of them available so you can see what we're all about because we want you to try it before you buy it.
Just like the one today. So thank you. Yeah, great point. Okay, yeah. And then as you go through and your SmartPath is turning green and your exam day is coming up, well, let's switch tactics and get ready for the exam itself. What better way to do it with the mock exam? So the first thing we've got is an exam simulator. It uses the same QBank that you've been using to achieve the targets met in your SmartPath, and it can be taken multiple times. The objective here is to make sure that you can manage your time successfully and get through that QBank. Okay, it's reusing the same questions. Some of them you may have seen, but after you've nailed that, guess what? Brand new mock exams, exam bank that you have not seen, brand new, also weighted proportional to that coverage on the exam itself. There's at least 2 per core and 1 per discipline, and this is going to yield you the score that's most endemic of your level of preparation. Again, all time to 4 hours, the mock exams weighted proportional to the coverage of the topic on the actual exam. So 2 options for you there. The bottom line is, 90% pass rate if you can do the 3 things. 75% of those targets met on that SmartPath, 60 days of continual study, 100 practice quizzes. You can do it, and we're here to help. And the guy that's going to help you more than any other is back to you, Pete.
Thank you, Mr. Quinn. Thank you so much. Appreciate it. Folks, I just want you, if you do not have a deal at your firm or you do not have a special pricing at your school and you'd like one, you can also contact Quinn. He can set that up for you. If you're not at a university and you're not at a major firm that's direct bill or reimbursing, then you want to get this QR code so that you can get the a better price than you would get on the website. This is a thank you for attending today. So definitely take a shot at that QR code. Quinn, I don't know if there's anything else you want to mention about that, but I do want to point out.
I'm taking a picture of it myself, Pete. That's amazing. So this is the full Elite Unlimited. This is the same one that's partnered with Big 4 firms, over 200 universities, over 200 firms. Actually, it's 480 firms plus. This is it. So if you want to transform your CPA journey today, pull out the phone, grab a picture, and let's make it happen. Julie's provided all the features on the left there. A couple others that I'll just call out real quick that folks seem to really like are, first of all, you asked. So you've got an AI study companion that's available in the system. It's a great way to get clarity on specific questions or topics that may be challenging for you. At UWorld, we do not nickel and dime you. We stay with you until you pass the exam as long as you're active in it. And, some of the other highlights that we provided. So anyway, thank you so much for the time, Pete.
You got it, brother. Thank you, thank you, thank you. Well, thank you, everybody. We are now going to show you how statement of cash flow could be tested in a task-based simulation. But as I mentioned earlier, the AICPA blueprints and our texts are perfectly aligned. So when our lectures are aligned to the textbook, it's not all over the place. But most importantly, like everybody thinks, okay, if I just know the statement of cash flow, net income, make my adjustments, I'll get top operating cash flow. Sometimes they don't test it explicitly like that. You've got to back into numbers because they've provided wrong numbers and you got to find the mistakes. It's not that you can't do it. It's just a different way of testing it, right? So they've told us in advance they want you to be able to detect, investigate, and then correct errors in the preparation of the statement of cash flow. So that's what we're going to show you how now the statement of cash flow being tested in a task-based simulation, but not as obvious as just do operating, investing, and financing. All right, so another review course attempted to do the statement of cash flow, but had tons of errors because they don't know what they're doing. Are you kidding me? Man, these people, you want to know the best endorsement? 3 years I left. 3 years, I broke up with you. Would you take my picture down from your dining room wall? Would you get me off your videos? It's been 3 years. What are we doing? But what better endorsement? What better endorsement? You got to love it. Now, the problem is I ain't getting royalties. So I got a big problem with this. So my representative, I'm suing his ass for malpractice because I ain't getting no freaking royalties. The only problem is in that lawsuit, I'm both the plaintiff and the defendant. Yeah, so you know why they say lawyers should not represent themselves, right? They got a fool for a client. I am that fool, so you know. But listen, I'm building your confidence. If my dumb ass passed the CPA and my IQ is in the left tail, my work ethic is in the right tail, but my IQ is over here. Shit, you should be getting a perfect score, baby. All right, nonetheless, we got to find our errors and correct them. All right, don't make an error of choosing the wrong course. You know what? You don't want that old, outdated course. Hell no. Hell no. There's a new sheriff in town. There's a whole new you world, baby. So here we go. You ready? Now, what I recommend on exam day and what I recommend when you practice the task-based simulations, it's extremely important that you don't get bogged down in the facts and all the exhibits that you have no clue what to do with yet because you haven't read the requirements. Now, obviously, we are in a statement of cash flow lecture, and I've already told you what we're going to have to do with these facts, okay? But obviously, exam day, you wouldn't know that. So we always suggest when you practice your task-based simulations, you start with your requirements so you can identify the topic. The first thing you always want to do, you start with the requirements so you can identify the topic. Once you've identified the topic, your formulas or your T accounts, whatever it is that relates to that topic and is going to help you solve those problems, put down those formulas and those T accounts. Step 3 is now you read the facts. You're going to open your exhibits, but in context. Now you know what to do with it. But now you know what to do with it such that you're not going to have to constantly reread. Look, the problem with the task-based simulations is not so much that people don't know how to solve it. 2 of us, we get the exact same simulation. We both get a perfect score. But if it took you 15 minutes and it took me 30 minutes, I got a big problem now finishing the exam. And now my margin for error goes down because if I only complete 90% of the exam, I got to get a much higher percent correct to get that magic 75 exam day, right? So we're not going to have that happen. We're going to teach you, Megan, in those task-based simulation mastery videos, is going to teach you how to read it and set it up. So not only do you get it right, you get it right in the time allotted. In addition, when you open up testlets 3, 4, and 5, you're going to have multiple problems that you've got to solve. Do me a favor, legalize cheating again. Please do not work those problems in the order presented unless coincidentally that's the best order for you. Identify the topics within the testlet. Strongest topic gets worked first. Leave your weakest topic for last. Because if I got to rush and run out of time, I'm going to rush and run out of time on my worst topic, not my best topic. Okay, so we're going to teach you all these techniques. But ultimately, this is the problem we have. So I've read the requirements. I see it's a statement of cash flow question. I know I got to identify errors and find the corrections. Okay, so I've read the requirements. Now I'm reading the facts in context. So there are errors. We got to fix it. So using the exhibits, all this additional information, I've got to determine what's the correct amount for operating, investing, and financing. And I was in class, and I remember Pete saying cash flow from operating, plus or minus cash flow from investing, plus or minus my cash flow from financing. That gets me my change in cash, and I'm going to know that per my balance sheet. So I am going to find, if they gave me a comparative balance sheet, I will know this answer before I find these three numbers, and then I'll know if I got those three amounts correct. All right, so let's take a look at our facts. Here we go. So what did they give me here? So here is the draft. This is the unadjusted. This is what they screwed up. All right, that unadjusted statement of cash flow. Notice, like the income statement, it's for a period of time, unlike the balance sheet, which is as of a particular date. All right, so let me just look. They took net income. They should have added back depreciation. Where's the depreciation? Where's the beef? All right, so I got to find this per my income statement. What is that depreciation expense? And I'll show you another way to back into it. If it's not on the income statement, I'll show you. Okay, it all depends upon the facts. Gains need to be subtracted. All right, so that gain on an available for sale, wait a second, available for sale. So I got a gain. They sold an available for sale debt security. Wait a second, that gain made net income go up, but that's not part of my core business. Okay, so I got to subtract out that gain. Increase in inventory, that's an operating asset. What should I do? That should be added, right? Change in operating assets. All right, so I got an increase. So subtract your change in operating assets, we do the opposite. So if the operating asset went up, this should be, okay, wait a second, they're adding. That should be subtracted, not added. So I found an error right there. That's got to be subtracted. Subtract, do the opposite. Add your change, though, in operating liabilities. Decrease in accounts payable, an operating liability. So if operating assets go up, you subtract. When you have a decrease in accounts payable, keep the sign. The plus sign means keep the sign. So that means this should be deducted. That should be subtracted. Is it deducted? It is. Okay, so that looks okay. I don't know about the amount. Okay, cash flow from investing. Hey, that's the change in my non-current assets. I got the proceeds from the sale of a building. Okay, so as long as that's cash, not a note, okay, but cash. Payment for a PP&E purchase, that's an outflow. Okay, that looks okay when you're on the buy side. An outflow, I don't know about anything else. Proceeds, cash flow from financing, change in my own debt and equity. My own debt and equity. So proceeds from a stock issuance, that should be an inflow. Proceeds from the sale of available for sale debt securities. Wait a second. An available for sale debt security is not my own. That's an investment in another company. We bought somebody else's bond. This is investing. That's got to be moved up here. Okay, that should be investing inflow. That should be investing inflow. That's not my own debt. It's somebody else's. All right, I sold somebody else's. So that's proceeds. That's a change in a non-current asset. Cash dividends, so long as it was paid, remember, not property, not stock. Okay, it's got to be cash, and it can't merely be declared. It's got to be paid. Proceeds from a short-term bank loan. I don't care that it's short-term. It doesn't matter. All right, bank loan is negotiated debt. That should be financing. So that looks okay. That's proceeds. All right, now, net increase, decrease in cash, $820,000. I want to know, does that equal change in cash per that comparative balance sheet? So let's see. I'm going to my comparative balance sheet. There we go. Right there. $310,000 increase. All right, 820 is wrong. That should be 310. All right, so this should be a plus $310,000. Now remember, they said the statement of cash flow had the errors, not the balance sheet. So I believe the number on the balance sheet. All right, so the cash flow from operating plus or minus the cash flow from investing plus or minus the cash flow from financing, there's my check figure. There's my change in cash. I got to get to a plus 310. All righty, now here are my operating assets. I subtract the change in my operating assets. I do the opposite. All right, so I do the opposite. Accounts receivable, let's see, no change, 100, 100. Inventory, notice year 2, year 1. Here's the current year. Here's the prior year. So it went from 460 to 540, a plus 80. So what do I got to do? Subtract. That should be a deduction, a subtract $80,000. Long-term investments, all of this is change. And non-current assets, this is cash flow from investing. Okay, my long-term investments, not trading, not available for sale, not trading, held for trading, not fair value through P&L, my long-term investments. So $1.5 million, $1.6 million, we have a sale. It went down. So that's a sale. Okay, now that's 100,000 decrease. I don't know what I sold it for, but I do know that went down by 100,000. PP&E. Now I'm going to show you a trick. What I like to do with the PP&E, I could do net book value or I could do the gross amount. First of all, I want to do the net book value, and I'll show you why. This is going to be helpful in PP&E, separate and apart from the statement of cash flow. So your PP&E, excluding your land, remember, land doesn't get depreciated. So PP&E minus my accumulated depreciation, land doesn't get depreciated. So this is the net book value on my PP&E. Net book value, PP&E, excluding land, 4,000,001 minus 1,000,002, 2,000,009. That's my ending balance. My beginning balance, 3,000,004 minus 1,000,002. Net book value beginning, 2,000,002. All right, here we go. So you guys are going to make a flashcard with me. You ready? I'm going to teach you how to analyze, so no matter how you have to find the information, you could do it. Net book value of PP&E. This is going to be helpful in two different lectures. You've got a beginning balance, what you buy, also known capital expenditures. That's what you buy. There's your ending balance. This makes PP&E go up. What makes net book value of PP&E go down? Current year depreciation and the net book value of any PP&E sold. All righty. So now I'm going to plug in numbers. So we just saw PP&E had a beginning balance of 2,000,002. Drop the zeros so you can move more quickly. Ending balance of 2,000,009. All righty. Now, I want to find net book value of any PP&E that was sold during the year. And then I can find my current year depreciation, or vice versa. Where's another place you can find current year depreciation? Your income statement. Okay. So let me just see. Do I have my income statement? I have a partial income statement. Did they tell me my current year depreciation? I don't see any current year depreciation there. Okay, current year depreciation. I flip through again. Do I see an income statement anywhere? I don't. All right, so I'm scanning this, but what I do see is some property, plant, and equipment transactions. A building with an original cost of $600,000, a carrying value of $350, was sold for $350. That's a cash inflow investing, unless they tell me otherwise. Okay, we also had a purchase. Okay, so I could look at my PP&E now. They tell me I had a price of 600. It had a carrying amount, a net book value, cost minus accumulated depreciation, a net book value of 350. Okay. And let's see, with an original, I'm sorry, the selling price was not 600,000. It was sold for 350. Selling price 350, net book value 350. So gain, loss, 0. All right. So this is my cash inflow investing, my proceeds on sale. It was sold for 350. Okay. That's my selling price. So my original cost was 600,000. So we can infer then what that accumulated depreciation must have been on that item sold, right? We can infer what that accumulated depreciation must have been. All right, if we need that number. What I want to do is I want to focus in on this net book value. It had a net book value of 350. Do me a favor. We sold $350,000 worth of stuff. Okay, we sold $350,000 worth of stuff. Okay, so now we have another piece of the puzzle. We still haven't found our current year depreciation because I don't see an income statement, and I don't know exactly how much I bought during the year. So now I'm going to look at my PP&E, the gross amount. PP&E, your gross amount. Okay, you've got your beginning cost. Okay, your beginning cost, or I should say carrying value or cost, Let's call it cost. It's the gross amount. You got your ending cost. Now, what makes PP&E go up? What you buy. What makes it go down? What you sold. Okay, the original cost of what we sold. They just told us we sold $600,000, original cost of $600,000. Agreed? Given information. So cost minus accumulated depreciation. So $600,000 was sold. Sorry about that, wrong direction. There we go. $600,000 was sold. So now let me go back to my balance sheet. What was my beginning cost for my PP&E? My beginning balance was $3,000,004. My ending balance was $4,000,001. $3,000,004, $4,000,001, right? Dropping the zeros. So obviously, if you take $3,000,004 and you subtract 600,000, well, $3,000,004 minus 600,000, what is that? 2,000,008. That's what your ending balance would have been had we had no purchases, right? If you had no purchases, your ending balance would be 2,000,008. Obviously, we must have had purchases. How much did we purchase? Well, if my actual ending balance is 4,000,001, it's not 2,000,008. It's not 2,000,008. We must have purchased how much stuff? I must have bought 1,000,003. That's an investing outflow. Okay, I just want to show you various ways of finding these numbers. Okay, so your gross amount. Now, we've just decided that we had purchases of 1,000,003, right? We just had purchases of 1,000,003. Haven't depreciated anything yet. We had purchases of 1,000,003. Okay, so you ready? Let's find current year depreciation. What must that be? Well, 2,000,002 plus we bought 1,000,003 worth of stuff. What does that get us? 2,000,002 plus the 1,000,003. Well, that gets us 3,500,000. Agreed? 3,500,000. So we've got purchases of 1,000,003. Our ending balance, though, certainly is not 2,000,009. Well, we have net book value sold of 350. Okay, so let's take that 2,002 plus the 1,003, that 3,005,000. Let's take 3,005,000, and I can't read my own handwriting. Let me get my trusty calculator. Hold on. 3,005,000. Let's see. We subtract 350. Net book value PP&E sold. What do we get? 3,005,000. Let's see. Minus 350. 3,005,000 minus 350. What do we get? 3,150,000. Well, that sure as hell is not our ending balance. Okay, so 3,005,000. Sorry about that. Minus 350. That's 3,150,000. That would have been our ending balance if we had no current year depreciation. Okay, obviously we do have current year depreciation. Okay, since your ending balance is not 3,150,000, 3,150,000 minus 3,150,000 minus 2,009,000. What's got to be our depreciation expense? It's got to be what? $250,000. That's got to be our depreciation. Okay, and that gets added back to net income. So we have one way of finding our depreciation. Okay, that's one way of finding our depreciation. Okay, using that T account there. So the goal is not for the hell of it, but every exam, different missing pieces of the puzzle. So it doesn't hurt to have multiple ways of finding missing information. Now, I'm going to add one more to this because this is 2 for 1. This is also in the PP&E lecture. Okay, your accumulated depreciation we know is a contra asset, right? It's got a credit balance. So this makes it go up. This makes it goes down. Beginning balance. Here's your ending balance. What makes accumulated depreciation go up? Current year depreciation makes accumulated depreciation go up. What makes accumulated depreciation go down? The accumulated depreciation on PP&E that was sold. Isn't that right? What's your journal entry when you sell an asset? You're going to debit your cash if you sell it, right? Your selling price, you'll debit your cash. How do you get rid of a contra asset with a debit, right? So any accumulated depreciation on the asset that we sold, your original cost, and then your plug figure to make it balance. A gain, you'll credit. A loss, you'll debit. Isn't that right? All right, so let's now go back to our balance sheet. Let's find our accumulated depreciation, not for the hell of it, but different ways of backing in. Beginning balance, $1.2 million. Ending balance, $1.2 million. That's interesting. So my beginning balance is $1.2 million. My ending balance is $1.2 million. Now I saw that we sold property, right? We sold property. What was that property we sold again? Well, let's go back to the facts. What was that property that we sold? Well, the property we sold had an original cost of $600,000, a net book value of $350,000 that was sold for $350,000. So if it had an original cost of $600,000 and it had a net book value of $350,000, 600 minus what is going to get you $350,000? Well, 600 minus $350,000, accumulated depreciation must be how much? $250,000. It's got to be $250,000. Our journal entry would be to debit cash for $350,000, debit accumulated depreciation for $250,000, right? Credit our cost, $600,000. Now this adds up to $600,000, so there's no gain or loss. Oh yeah, gain or loss. That's right, zero. Right? All ties together. But the accumulated depreciation on the asset sold had to be $250,000 because they gave us the original cost and its net book value. All right, so now let me go back to this T account here. That's $250,000. All right. Now, obviously, if you take $1.2 million and you subtract $250,000, you don't get $1.2 million. Okay, so $1.2 million minus $250,000. Again, I can't read my ugly handwriting. $1.2 million minus $250,000. What do you get? $950,000. Well, that is obviously not our ending balance. Our ending balance is actually $1.2 million. Right? So $1.2 million minus the $950,000. Oh yeah, current year depreciation has to be what? $250,000. Does that match what we got earlier? You bet it does. Current year depreciation, $250,000. Multiple ways of finding missing pieces of the puzzle, not for the hell of it. Remember, PP&E is its own topic that could be tested in FAR. All righty, so these T accounts will be useful there. If it's a PP&E question, obviously very useful statement of cash flow. The reason why it's so important on the statement of cash flow, because we can find our cash flow investing. If I know my beginning balance, my ending balance, current year depreciation, the net book value, I can find what I bought. That's a cash outflow investing, $1.3 million. All righty. And we also know our depreciation now is $250,000. So all of these different formulas are going to be used in multiple places. You know what that tells you? When it appears in multiple subtopics, it's definitely getting tested. Whether it's tested part of statement of cash flow, statement of income statement, or PP&E, the balance sheet, you've got to know these T accounts. They have to be your friends. All right, so using net book value, if they don't give you the accumulated depreciation, they only give you the net book value, or you have the gross and the accumulated depreciation, I can work with any of these T accounts. Okay, I can work with any one. All right, so obviously we've got our all our PP&E solved. So net income, that's the starting point, $790. Long-term investments available for sale securities was sold for $135. There were no other transactions, so we got a selling price of $135 minus the carrying value. Well, there's your gain or loss. Now, I do believe they told us we had a gain. Let's see. I saw a gain. Yeah, a gain on sale of $35. Is that right? Is that right? What was the carrying value? I don't know. Let's see. So they're telling me that I had $350. Where did I have that number? Excuse me, $35. So was the carrying value, in fact, $100,000? This will be a cash inflow. And what was it called? Available for sale. So that's going to be a cash inflow investing. Okay. I just want to check. Is 35 right? Well, let's see. Long-term investment available for sale. Is that on my balance sheet? It sure is right here. It went from $1.6 million last year to $1.5 million this year. Oh yeah, that's the right number, 100,000. We had a sale. It went down by 100,000. So let me just double check then. Is that the right number? Did they get the right? Oh yes, they did. But it's because the carrying value on the balance sheet was 100. They sold it for 135. Yeah, that is a gain of 35. That is correct. What did we do with that gain? Made net income go up, but that's not part of my core business. All righty, so we got that piece of the puzzle. Cash dividends of 500,000. They were declared. How do I know if they were paid? How do you know if they were paid? Well, I remember from class, statement of retained earnings. Again, this is in, what did I do there? Sorry, folks. New slide. There we go. Per my statement of retained earnings, right? You got your beginning retained earnings plus your current year profit or minus your current year loss, minus your dividends declared, which they just said were $500,000. There's your ending retained earnings. Now, just as an FYI, if they did not give me the dividends declared, I could find it. Now, why is that important? Beginning dividend payable plus the current year amount declared, 500. There's the total we owe our stockholders minus the ending dividend payable. That gets us the dividend what? Paid. And I'm only concerned about dividends that were paid. So now I know my dividend declared 500. If they didn't give me the 500 though, I could certainly back into it. All right, so we got that piece of the puzzle. We'll deal with that in 1 second. I want to take a look at my last note here. Just as an FYI, let's just see. We also, sorry about that, we also, 10,000 shares of stock were issued for $22 a share. That's cash inflow. What category? Financing. The 10,000 times the 22, it's going to go up stated capital, additional paid in capital, and excess of par. Okay, that's a cash inflow financing. All right, so we got a lot of information. I only want to answer the questions asked. I don't want to go beyond the scope. So now let's take it one by one. What did they ask me for? Okay, so depreciation expense, that should not be a zero. We need to add back $250,000 to net income. And we solve for that in 2 different ways. Using an accumulated depreciation T account or net book value for PP&E, or obviously an income statement, okay? Or if they give it to you on the income statement, okay? So that answers that. So we got the 250, okay? So different ways of finding the 250. All right, using T accounts, specifically, you could do your accumulated depreciation, which we did, beginning balance, ending balance, the sale of the building. This was the accumulated depreciation on the sale. So we took the $1.2 million, subtracted the 250. We said, wait a second, 950 is not our ending balance. Yeah, it's not our ending balance because $1.2 million minus 250, just coincidentally, same number. Well, excuse me, $1.2 million minus that 950, we must have had current year depreciation of 250. So that's method 1 of 2. Okay, or you can use the net book value of your PP&E. If you're doing net book value of your PP&E, your T account is what again? Your beginning balance plus what you buy. There's your ending balance. Current year depreciation makes it go down. Net book value of any asset sold makes it go down. Okay, so depending upon what they give you, you have 2 ways of finding your depreciation expense if they don't give you an income statement. Okay, next up, they tell us, hey, gain on sale. What do we do with the gain on sale? You subtract that $35,000. We took the selling price, we found that $135. Per the balance sheet, we saw long-term investments went down by $100,000, and that's $135. Sorry about that. So that was the carrying value at the time of sale. $35,000 was in fact my gain. They subtracted the gain. Good. Okay, so we only want to answer the questions asked. That's okay. All right, so that available for sale debt security was sold for $135. We confirmed the gain of $35 because we found on the balance sheet that the carrying value at the time of sale was $100,000. Okay, cool. So there's our 100,000. We're in good shape. If they ask for journal entries, there you go. We always give you more than what the question asked for, reviewing the rule in its entirety. Okay, non-current asset. You got that gain that made net income go up, but that's not part of our core business. Thus, we deduct it. We subtract the 35, and there's your journal entry. The cash received is what? Cash inflow. What category? Investing, if we needed it. There's your cash flow investing. Okay, next up, increase in inventory. So we subtract the change in an operating asset. What does this subtract mean? You reverse. If it increases, what should we do? We don't add it. What should we do? This should be subtracted. That should have been subtracted, not added. They screwed that up. Since it's an increase, you got to subtract it. If it goes up, we reverse the sign. So that's our change in our operating asset. So we make that correction. Next up, decrease in accounts payable, operating assets. You add the change in the operating asset. What does the plus sign mean? Keep the sign. If it goes up, add it. If it goes down, subtract it. It decreased, they subtracted it. Okay. They did it correctly. All right. So decrease in accounts payable. Cool. Next up. They tell us proceeds from the sale of a building. A building is what? PP&E. So long as it's cash received, you're okay. Since this is cash received, that should be an investing item, a plus 350. So that is okay. Remember, your selling price, unless they tell you otherwise, minus your net book value is how you get your gain or loss. Net book value is always a function of what? Cost minus accumulated depreciation. And we're going to need those in various T accounts. We can find any missing piece of the puzzle. Okay, here our selling price was 350. Our net book value was 350. No gain, no loss. Original cost was given. We surmised that the accumulated depreciation on that asset had to be how much? 250. Okay, so again, 2 for 1, statement of cash flow or part of your PP&E. All right, now remember, sometimes you sell, but you get a note receivable. If you sold it and got a note receivable, that would be non-cash investing and financing. You might sell it for 350, get 100,000 cash, a $250,000 note. That's fine, but only 100,000 would be cash flow from investing. The 250 would be non-cash investing and financing. Okay. We purchased PP&E. Wait a second. Where the hell did they get 700,000 from? My net book value of my PP&E, I had a beginning balance. I had an ending balance, right? Beginning balance, ending balance. My current year depreciation, we found 250. My beginning balance was given 2,200,000. My ending balance was given 2,900,000. We found current year depreciation in the prior question. We also we're told the net book value of the asset sold was 350. Okay, so 2,200,000 minus 250, that made it go down. Minus 350, that made it go down. That's 1,600,000. Well, wait a second. My ending balance is not 1,600,000. Why? Because you must have bought stuff. That's called a capital expenditure. That's an investing outflow. This is what you bought. Okay, so we must have bought how much? Well, the actual ending balance is 2,900,000. It's not 1,600,000. So we must have bought how much stuff? We must have bought 1,300,000 investing outflow. So that's wrong. That should be 1,300,000 outflow. An outflow, brackets around it. That means it's an outflow. So that's investing, but that should be an investing outflow. The 700,000 is wrong. Okay, so that's a cash outflow from investing. Got it? Okay. Now, they told us, obviously, there were purchases, but the amount was unknown. Now, remember, be careful. We're only looking for the cash paid. If you buy PP&E, but issue a note or issue stock, then that's not on the face of the statement of cash flow. The portion you paid for with stock or debt, non-cash investing and financing, supplemental disclosure. Here, they didn't give us any other information. So we paid all cash. Now, another way of doing this. You ready? The PP&E, the gross amount. Okay. Beginning balance was given information. The ending balance was given information. The sale of the building, this is the original cost of the building sold. Remember, we debited our selling price, our cash, $350. We debited accumulated depreciation, $250, right? We credited the cost, $600, no gain or loss. All right, so obviously, $3,000,004 minus 600,000 does not give you the ending balance. When you look at the gross PP&E, the $3,000,004 minus 600,000 gets you $2,000,008. The actual ending balance, though, is $4,000,001, not $2,000,008. So that tells me we must have had purchases, therefore, of how much? $1,000,003. So check it out. We've got two ways to find. This is method 2 of 2, using the gross PP&E, should that be given information, or method 1 of 2, using net book value, all depending upon what's given. Okay? Not for the hell of it. And this is going to help us, we know, in 2 different areas on the CPA exam. So far, it could be in PP&E or part of statement of cash flow. Proceeds from the sale of stock, they issued 10,000 shares at $220. So that's an inflow, financing, so that's okay. They got it as a plus 220, financing inflow, that's fine. Okay, we issued our own stock, financing inflow. So 10,000 at the 22. Now on the balance sheet, some of that would be in stated capital for the par, and the rest of that would be in paid in capital in excess of par, such that the total of the two is $220,000 if we had to find it that way. So if you go to your balance sheet, if you go back to your balance sheet here, way back up here, we have other ways of finding, we have other ways of making you talk. Yes, we do. We have ways of finding this information, all depending upon what's given. So if we look at our change in stock, plus 100,000 on the stated capital, because that's the 10 par, 10,000 shares at $10. And then the 10,000 times the 22 minus the 10, the surplus 120 plus 220, financing inflow. Okay, financing inflow. Now, my beginning retained earnings plus my net income minus my dividends declared, beginning retained earnings, $2,775,000 plus current year net income. What was our current year net income? They gave us that. I believe it was $790. Short-term memory, not so good. Sugar bear. Let's go. What is our net income? $790. There it is. So that was a correct figure. So $2,775,000 plus $790. $2,775,000 to be exact. So $2,775,000 plus $790, not $290. $2,775,000 plus $790, that gets us $3,565,000. Well, that is not my ending balance, is it? My actual ending balance is only $3,065,000. That means the dividends declared must have been how much? $500,000. The question is, was that paid or not? So I go to my balance sheet and I'm looking for, on my balance sheet, sorry about that, I just had the balance sheet in front of me. Do I have a dividends payable? I sure do. I have a dividends payable. So my beginning dividends payable, $240, plus the current year amount we just declared, $500. We owe $740. How much was not paid? Well, the not paid was $400. That's the ending dividends payable. Here's your beginning balance, prior year. Here's your ending. So that means the dividends paid must have been how much? $340. While I declared $500,000, that doesn't mean I paid it. And by the way, if there were no dividend payable on the balance sheet, then your beginning balance is $0, your ending balance is $0. So whatever you declared, you must have paid. Okay, but that's how we find the dividends that were actually paid. Okay, so let's see. Decrease in accounts payable was fine. We got the proceeds sale of the building. Cool. Purchase of PP&E. We got 2 finding that proceeds from the issuance of stock. So 220,000, we had that. We could have found that on the balance sheet as well. Proceeds from the sale of available for sale securities. Now, what's the problem with that? That's an investment. That is not our own stock. Available for sale, that is not our own stock. If it was our own stock, what would they call it? Treasury stock. When you repurchase it, treasury stock goes up, reissue it, it goes down. So the proceeds from the sale, that shouldn't be financing inflow. That should be investing inflow. All investments are investing except what? If you see trading security, also known as held for trading, my friends around the world, what you all call fair value through P&L, current asset, that's operating. Otherwise, investments are investing, okay, except for those, all right? So that should be investing inflow. We know we got to move that to investing, okay? There's our gain. What do we do with the gain? That gets deducted from net income, okay? But that should be investing inflow, available for sale debt. That is not our own debt or equity, I should have said here. That's not our own debt or equity, not our own debt or equity is a better way to say it. Not our own debt or equity, somebody else's. Okay, cash dividends paid. What do we think about that? 340. That is correct. How did we do that? Statement of retained earnings. Remember, US GAAP is very rigid, unlike IFRS, which is flexible. Dividends, it's got to be cash, not stock, not property. Not stock, not property. And it cannot be just declared. It's got to be paid. Your beginning dividend payable plus the current year that you declare, that's the total you owe. Take your ending dividend payable that you didn't pay, and there's what you paid. You could do that with any expense, by the way. Okay, the beginning payable plus the current year corresponding expense, the total you owe, either you paid it or you didn't. All right, so we found that right there. We backed into that. Sweet, sweet, sweet. Cash dividends, $500,000 declared, but 340 were paid. We combine that with what? Statement of retained earnings. If they didn't give us, if this were not given, if not given, where would you find that? Statement of retained earnings. You got to remember to look there. We were kind. They're not going to be so kind. So if they don't tell you anything about dividends, you better see your statement of retained earnings with dividends declared, then check your balance sheet to see if there's any beginning or ending dividend payable. All right, so obviously our dividends payable, you could use a T account. Proceeds from a short-term bank loan. Now, bank is negotiated, right? So anytime it's negotiated, financing inflow, okay? Bank loan, interest bearing, that's negotiated debt. Okay, the short term doesn't matter. It's interest bearing. That makes it financing, not the fact that it's short term or long term. Is it interest bearing? Okay, a bank loan, a note, a debt, a bond, debenture. Okay, so a bank loan would be a promissory note. Here they're calling it a bank loan. Okay, so that's correct. No problem there. And then you just got to put the pieces of the puzzle together. Okay, so our check figure, when you get your cash flow from operating, cash flow from investing, cash flow from financing, what was the magic number? That matches change in cash per that comparative balance sheet. Woo, baby! See that? It wasn't a direct calculate statement of cash flow. It was fixing somebody else's errors. All righty, so cash flow from operating, investing, financing, netted out, there lies your change in cash. Okay, add your beginning, and there lies your ending cash. So this is a little sample. We teach directly from the freaking text. Nobody's reading pre-prepared scripts that don't match the text. You're confusing me. Where is this in the book? Where are you? No. Okay, we're very consistent to make it very obvious where we are. Now, look, it's a back and forth approach at UWorld. You've got to put the pen to the paper. As I'm writing it, you cannot watch or read, man. Again, like it's like going to the gym with me and watching me on the treadmill. It ain't helping you. You've got to put the pen to the paper. Not only do you write it, you speak it. Now, I'm going to make a recommendation. You're not memorizing all this detail. That cheat sheet I gave you earlier, that's what I said is your date for tonight, where you're going to learn that cash flow from operating, wherever I had that. Somewhere I gave you the whole point. I know I did it somewhere, but I gave it to you somewhere. So wherever the hell it was, listen to me. The day before the exam, you shouldn't be taking mocks the day before the exam, right? It burns you out. What you want to do is you want to practice a 2 to 3 minute, what I'm going to call a cheat sheet. And in FAR, like I know the statement of cash flow and inside out is what I do for a living. For you, you've committed to memory, net income, add back depreciation, add back losses. First thing you're going to do, exam day, you're going to regurgitate what you practiced the day or two before, that 2 or 3 minute regurgitation of formulas that before they even put me on the spot, it was emphasized all over the UWorld in the questions, the multiple choice, task-based simulation, the lecture. I know I got to know this, but I'm not waiting for them to ask me, because what I could easily recall the second I start the exam could be really difficult to recall in 5 minutes after I work some questions, and I just get a little bit nervous. Don't let that happen to you. So the day or two before the exam, what are we practicing? Our 2 or 3 minute cheat sheet that's better come out of your head and not a piece of paper in your pocket. As soon as they say you can write, man, you're regurgitating this stuff, and you'll thank yourself. Because then when you get to that question, you can refer to it. Woo, baby. All right, Megan, Quinn, everybody. Oh, Quinn, I got to invite you back. I'm sorry, pal. Real quick, I think we wanted to give you something else here. So, Quinn, I'm going to turn it back over to you. I think real quick.
Great job there, Pete. Thank you. Yeah, that's incredible, man.
All right. So we had a couple of things we wanted to wrap up with. All right, there we go.
I think, yeah, there we go. Okay. If you like this, it's the first of many that we have. There's a whole entire task-based simulation mastery series, deep dive into the TBSs. You've got 2 of the best, Dr. Megan Burke and Dr. Jeannie Yamamura. Next one is going to be in August 20th, 3 to 4 Central Standard Time. So, oh man, Pete, you got to stop that. Anyway, get out your phones and hit that QR code. You'll see the whole schedule. And there's a great YouTube page featuring all of our webinars, terrific assets. Really encourage you to check that out. So if you got something out of today, you'll definitely get something out of the next ones coming up in August. Also, if you're interested in partnering, we'd love to work with you. Join our cadre of existing partners and firms and university partnerships. That's the code on the right. If you want to enroll and you're just like, listen, I'm ready to do it. I'm sick of not passing this exam. Let's go. Go ahead and hit that enroll now. And that code is going to be CPA webinar. And that is let me tell you, that's a special price. It's a limited time offer. I think expires August 15th. So on behalf of the UWorld team, Megan and Julie, and of course, Mr. Peter Olinto, thank you so much. Julie's telling me, make sure to check out our webinar recordings. You'll see all the previous ones. They're all archived up there. Thank you so much, guys. Thanks for making today a success.
And Quinn, thank you so much for your time. Folks, listen to me. Again, if you're at a school and you want me to come speak about the CPA exam, CFA exam, law school, combining a CPA, JD, you want to be a UWorld ambassador, partner with us, because I would love to come to your school, talk about all those things, talk about electives you might want to take, the order in which you might want to take the different parts, on average, how many hours you should be studying. So it's something we love to do. So we're visiting schools, University of Georgia, all over the place. I got to give a shout out to my friends, Deloitte, Philly and Deloitte, New Jersey. I was just in their offices. So if you joined us, I got to give a shout out to them. If you're at a firm and you want to be with us, and again, if you're not currently, reach out to Quinn, but I'm on LinkedIn. So look, you got a friend now. You have any questions, you hit me up on LinkedIn. I will get back to you. Peter, last name is Olinto. And look, I take this very personal. This is so important to me to help you through this exam. This is what I do for a living. This is what Roger does. This entire team does. Nobody in this industry is as passionate as we are about this, okay? So you reach out, you got any questions, I'd love to help you out. If you're failing with another course, don't keep doing the same thing and expect a different result, right? That's insanity. We will get you a make the switch discount. You need a new, fresh set of questions, new test bank. Please don't spend all that time and keep reworking the same things when you know the answer is A because you've worked it 3 times, okay? Work with Quinn. He'll get you a great price, different from what you saw here today, and you can make the switch to UWorld. You're the best customer for us. because nobody does better job selling this than somebody who took that other freaking course. I forget what they call Wrecker or something, and then took us and passed and can speak intelligently about both products. So we will work with you to get you that in your hands. But sincerely, thank you so much for joining us. We really do appreciate your time. Wish you all the very best. And yeah, hopefully I'll see you guys at your school or your firm somewhere down the road. Good luck, Megan, Julie, everybody in the background. Thank you. And Quinn, once again, thank you. See you guys later.
Thank you. Bye-bye.
Bye.